Welcome back, everyone. Today, we're diving straight into the financial landscape of 2026 to figure out exactly where you should be putting your money. We're going to break down the absolute top investments available right now. So if you're looking to maximize your savings and actually get the highest possible returns, well, you're in the right place. Let's analyze the data and build you a clear roadmap.
Okay, let's get right into it. The best investments in 2026.
To kick off this countdown, we really need to address the core dilemma from our source data. If you have even a small amount of money, say just 1,000 rupees, where should it actually go to get the absolute maximum return in 2026? You know, I love this framing because it instantly shatters that huge myth that you need a fortune to start investing. You really don't. The principles we're talking about apply whether you're working with 1,000 or 1 million rupees. The real question is simply, where is that money going to work the absolute hardest for you?
Let's start on the safer side of things, fixed deposits and gold.
Coming in at number 5 on our list, we have the classic fixed deposit. Our source data projects FD returns hovering right around that 6 to 8% mark. And honestly, this represents pure predictability. A 6 to 8% return is steady, it's reliable, and it serves as the perfect, rock-solid baseline for our countdown today.
Stepping up to number 4, we've got gold. Now notice the upward shift here. We're moving from FTs to a projected 8 to 12% return for gold. It's traditionally acted as a really great physical hedge, but looking ahead to 2026, you're potentially snagging an extra 4% on the top end just by shifting your baseline asset. Pretty neat, right?
Moving up the ladder into growth territory, real estate and SIPs. Now we're looking at two incredibly powerful wealth-building tools. At number 3, we have real estate, which caps at about 10 to 15%. And at number 2, mutual funds and SIPs, which edge it out just slightly at the bottom end with 12 to 15%. But hey, the numbers don't tell the whole story here. For real estate, the data explicitly points out that it depends entirely on finding the right location. For SIPs, on the other hand, the absolute non-negotiable requirement is time. So one requires geographic precision, while the other, it requires a whole lot of patience.
And now for number 1, the stock market.
This right here is a massive jump. While FDs max out around 8% and gold pushes maybe 12%, the stock market just totally towers over them both, delivering an incredible 15 to 25% and potentially even more. I mean, that is a staggering leap in wealth generation. But listen, just like real estate required the exact right location, this requires the absolute right investment. It takes strategic, well-researched choices to actually hit those maximum returns.
But we can't talk about returns without talking about risk and return.
Here is the absolute golden rule of investing. The higher the return, the higher the risk. It is an unbreakable correlation. You literally cannot jump from an 8% FD to a 25% stock market return without absorbing some serious volatility. At the end of the day, you're essentially getting paid for the amount of risk you are willing to take on.
So that brings us right back to your own 2026 strategy. Looking at this entire spectrum, from the 6% safety net of an FD to the 15% steady growth of real estate and SIPs, all the way up to that 25% high-stakes stock market, where do you fall? Which vehicle do you think offers the absolute best balance of risk and reward for your hard-earned money? Drop a comment below and let us know your game plan. And hey, if this explainer helped map out your financial future, make sure to follow us for more deep dives into the data. Catch you next time.